How is everyone doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. I hope everyone had a wonderful Father's Day weekend out there over the last couple of days. But here we are. It's Monday. We're ready to kick the week off. And so what I wanted to get to everybody was an M&A update. So what's going on in the world of banking mergers and acquisitions? So what I have for everyone today is I've got 3 articles from S&P Global, and I have 1 blog post from PCBB, all focusing on how have M&A been doing basically through the first 5 months of 2025. So let's jump in and take a look, and let's hit the numbers here. So I'm going to run down all the way to the bottom first, because I just want to show everybody. So here are the baseline numbers. So we can see here from 2024, we basically had 125 deals, total value around 16.27 billion. Assets sold 170 billion, deposits 140 billion, and then median deal value to tangible common equity was 130.4%. So how are we doing so far in 25? Well, so far we've done through the first 5 months of the year, we've done 57 transactions for a total deal value of only 5.39 billion. So pretty light. Assets sold 65 billion. 54 billion in deposits for a median deal value to tangible common equity of 147.9%. So a little bit up on the median deal value to tangible common equity. I guess they're looking at a little down here over the last couple of quarters here. But again, we see here, if we look at the chart below, we see here that 2024 was actually it was a little deceptive, I think, because the year started off very slow in the first quarter, and then it kind of built. Second and third quarter were kind of okay, and then the fourth quarter did well. But the median deal value to tangible common equity continued to elevate and increase until we basically got up into the first quarter of this year, which was good. And then it kind of dropped. It kind of came back down here over the first and second quarter. But so far, and again, and I just want to point out something. So obviously 2020 COVID year, only 62 trades. It's kind of amazing that 62 deals happened in 2020, to be honest with you. But we had 62 deals there. 2021 got back to what we saw as closer to a more normal year. And what I mean by that is, so from probably about 2011 through 2019, we kind of got used to being in an area of probably like 225 to 250 M&A transactions per year on average. That was kind of the pace that we were going at there for about a decade. And then obviously 2020 happened. And then, like I said, 2021, we kind of got back to that with 200 deals. Obviously, some of that was a lot of pent up demand from 2020. And then in 22, we slipped back to about 155 deals, and then slipped back in 23 to 97 deals. A lot of that between 22, and 23, a lot of that had to do with inflation, elevated interest rates, a lot of regulation coming out of the Democrats in Congress, and thus through the regulatory agencies. So it was kind of crimping a lot of the M&A transactions, not to mention the fact that the time frame was really being stretched out there for how long it was taking to get the M&A deals done. But, then, like I said, bounced back a little bit in 24 and 125, and now we're sitting at 57. So still a little light. So that just kind of gives everybody a time frame for okay, how are we doing overall? But let's look at some of the comments here real quick. So what do we have here? So 5 months into 2025, year over year, U.S. bank M&A activity has been flat. 11 deals were announced in May, bringing the total for the first 5 months of 2025 to 57, compared to the 56 deals announced during the same period in 2024, according to S&P Global. The total assets of targets have also been similar, with sellers from 2025 transactions having 65 billion in assets compared to 64.95 billion for targets through the 2024 equivalent period. So again, things pretty much the same. First 6 months of 2024, The first 5 months of 2025, pretty much the identical almost. Coming into the year, hopes were high that bank M&A would accelerate, with President Donald Trump's administration expected to pursue more economic-friendly policies and deregulation. Market volatility stemming from tariff announcements has made deal-making more challenging, but there are signs that the regulatory environment is becoming conducive around M&A. Deals are getting approved more quickly, and the expedited process can put companies in a better position to execute multiple deals in a year. For example, Stewart, Florida-based Seacoast Banking Corp. of Florida, for instance, announced in May its second M&A deal for 2025, agreeing to acquire the Villages, Florida-based Villages Bank Corp. C Corp's first announcement was in February, when it disclosed a $106.3 million deal for Sebring, Florida-based Heartland Bank shares. The 91-day period between the two announcements marks the shortest gap for a bank buyer on consecutive deals since Seacoast's 2022 acquisition announcement of Apollo Bank shares and Drummond Banking Company in a span of 36 days. The Villages Bancorp deal is Seacoast's largest among its 17 bank purchases since 2014, and the $710 million deal value makes it the 10th largest U.S. bank M&A transaction announced since 2024, according to market intelligence data. And then it gives us a chart here of kind of the largest U.S. bank deals announced since 2024. We're not going to really run through all of those. But then interesting, Midwest sees most activity. So in April, Worthington, Minnesota-based Worthington Federal Savings Banks disclosed a merger of mutuals with in-state peer Jackson Federal Savings and Loan Associates, while Princeburg, Minnesota-based PSB Financial Shares filed with the Federal Reserve Bank of Minneapolis an application to acquire of Lester Prairie, Minnesota-based First Community Bank, on May 28th. Community bank M&A has been picking up steam in the Gopher State as smaller banks team up to gain competitive advantage and capitalize on large banks' retreat from the state. Minnesota ties with Illinois as the most active state, with 5 announced deals so far in 2025. There were 20 deals announced in the first 5 months of 2025, targeting banks headquartered in the Midwest, making it the most active region, followed by the Southeast with 11 deals. And then it gives another chart with 11 most recent bank announcements. And then it talks a little bit about like Oklahoma and Massachusetts. And like I said, and then we kind of finish off with our chart there that we looked at the beginning. So, okay. So now that we have that base, we're going to take a look at a couple other things. So just to give us a little bit more flavor for what's happening in the M&A world. So this article is 4 $10 billion plus deals in May contribute to M&A revival. Now, this is more on a global basis. Like, what is M&A happening in the business world globally? So 4 M&A deals with a transaction value of more than $10 billion were announced worldwide in May, putting the second quarter's deal count one shy of the first quarter total. 2 deals were in the energy sector, one in the telecommunications sector and one in the consumer sector. Charter Communications' purchase of Cox Communications, announced May 16th, with a transaction value of $36.7 billion, is the third largest M&A deal by transaction value in the past 12 months, according to S&P Global. As deal consideration, Cox will receive $4 billion in cash and $6 billion in convertible preferred units in Charter's existing partnership, plus 33.6 million units in Charter's existing partnership, with an implied value of $11.9 billion, according to the merger release. The combined company will take on Cox's roughly $12 billion in outstanding debt. So again, they have a kind of a chart here showing large deals announced since 2018. So in for example, looks like the fourth quarter of 2024, we had 13 deals announced. First quarter, we had 7, and then we've got 6 so far here in the second quarter. And then it proceeds to say, after a quieter month with 2 $10 billion plus M&A deals announced in April, activity picked up as the environment began to settle from prolonged uncertainty. The market has absorbed large transaction announcements well after tariff-related market volatility. Goldman Sachs President and COO John Waldron said during an industry conference, "We've worked on a number of very sizable, important M&A transactions." Waldron said, "I still think there's a pretty strong, resilient M&A market, and if we get a little bit more certainty in the backdrop, you could see a pretty good size lift in volumes." So yes, I think that's very important. We'll keep that in mind. And then it goes into kind of like largest deals worldwide. We're not going to kind of get into all that. What I'm just trying to give you a flavor for is kind of where the overall M&A market is right now. So basically, it's certainly not busting at the seams, but it's not dead either. I would say it's kind of, in the middle. And I think there are a lot of people kind of languishing on the sidelines at the moment. So now let's look at this. This is from the Street Talk podcast by S&P Global. And this says balance sheet M&A and capital raising strategies for a volatile environment. So this reads, bank advisors and market participants believe bank M&A and IPO activity is in a holding pattern and will pick up once there is greater clarity over the macroeconomic and interest rate environment. That was the message delivered by a variety of presenters at S&P Global's annual Community Bankers Conference on May 19th and 20th and was highlighted in the latest Street Talk podcast. Attendees at the conference were keen to hear how to best prepare in periods of volatility, much like the one witnessed over the last few months since the Trump administration announced a broad suite of tariffs on April 2nd. Those protectionist policy led to spread widening in the credit markets and sparked considerable volatility in bank stocks. The path of interest rates remains just as uncertain as the Federal Reserve and the bond market weigh the prospect of slower economic growth against inflation and a wider deficit. Scott Hildebrand, chief balance sheet strategist and head of depository fixed income at Piper Sandler, said that banks should not try to predict interest rates and instead should prepare for different outcomes. He said banks need to recognize that 80% of their net interest income is driven off only 20% of the yield curve. He encouraged banks to understand that parts of the yield curve drive their business and then create triggers tied to movements in interest rates that would prompt balance sheet actions. We should be walking out of asset liability committee already knowing what we're going to do when we hit those triggers so that I don't write a memo to my boss after everything has happened and talk about how to protect what just happened, Hildebrand said. Many banks are seeking to lower deposit costs further, and the maturity schedule of their certificates of deposits will play a significant role in future deposit pricing. As those CDs mature, banks likely will have to meet the market rate to keep the funds. Joe Kennerson, managing director at Darlington Consulting Group, said banks have reported funding cost relief through April as their higher cost CDs matured. However, in the absence of further rate cuts by the Federal Reserve, Kennerson said banks might have to balance lowering cost against growing their deposits. Some banks have used acquisitions to bolster funding. In the last tightening cycle, more than a handful of banks in the metro markets purchased deposit-rich banks with low loan-to-deposit ratios in more rural markets. There have not been many of those deals recently, but Mark Canale, a partner at Alstone Bird, said that he expects to see more of those deals in the future as the M&A market warms up. So I do think the M&A wave that we've been talking about will gradually pick up. It's not going to be explosive, but I think it will gradually pick up again. I think a lot of these smaller core deposit franchises that you're talking about, the low loan to deposit ratio, I think they'll finally see clear sky to get that magic number they want. Scott Studwell, head of depositories and co-head of equity capital markets at Stephens, said M&A activity showed signs of picking up in early 2025, but the emergence of tariffs and fears over potential issues in the macroeconomy pushed passive investors to sidelines from the banking group. He still believes the fundamentals to support deals remain in place, but noted that the macro environment will play a large role in future capital flows. Over the last 7 years, we've had, 4 1 in 100 storm hits, so it's not going to be linear, but I think overall, when you peel back the noise, sentiment is still pretty good despite all the challenges we seem to be faced with, Studwell said. So there you have it. And again, it kind of goes on and it doesn't really, I think everybody else kind of echoes those same sentiments or those same comments. And then finally, we get this blog post here from PCBB, which basically has stats show 2025 is M&A's year, but what's helping deals succeed? So the market for bank mergers and acquisitions was on the quiet side last year, but it's picking up. We explain how CFIs can put themselves in the best positions as M&A returns. So again, they show the same chart that we just looked at a few minutes ago from S&P Global. And then it says, so what's behind the upswing? So it says, most recent bump in M&A activity took place in 21 during the COVID-19 pandemic. Increased regulatory scrutiny, slower processing times, and rising interest rates all work together to depress M&A rates for institutions of every size. By autumn 2024, that had changed. In 2023, just 12% of the top 50 U.S. banks were actively pursuing or open to M&A. In October of 24, 34% of the same group were actively pursuing or open to an M&A transaction. So regulatory easing is one factor behind the change, M&A interest picked up after last fall's presidential election, anticipating a more friendly environment. Financing institutions expect a leadership change at regulatory agencies will mean fewer antitrust challenges and expedited compliance reviews. Ironically, stricter regulations during the previous administration may have set up many financial institutions for successful M&A. Heightened capital requirements and strong supervisory conditions can make banks stronger and therefore either more desirable acquisitions or better placed purchasers. The U.S. banking's market fragmentation is another reason. The U.S. has a comparatively large number of small financial institutions, and some of them have struggled to achieve economies of scale. Lower interest rates and declining unrealized losses are additional reasons for more M&A interest. Over the past few years, higher interest rates meant that many community financial institutions and other banks had large unrealized losses on their investment securities, making them less appetizing targets for M&A. Lower rates and maturing securities will both help resolve that problem. But I would say, do we really have lower rates at the moment? I don't think so. Has the unrealized losses in banks' bond portfolios gone away? No, it is still a massive issue hanging over a lot of banks' balance sheets. And then it just goes into, how can CFIs prepare for M&A? It basically says, have a solid growth strategy, plan to integrate mindfully, focus on local footprint first, investigate technology integration needs, and then value current customers. So that hopefully will give everybody some insight to where we're at. So we had a lot of headwinds and tailwinds, right? And I think a lot of the stuff is clearing its way out of the way right now. Like, regulations are obviously easing. The time frame it takes to get an M&A deal done is coming back to normal. And all of that is good. What we're concerned with right now is obviously the interest rates. We need interest rates to come down. It would be fantastic if the Fed would actually lower interest rates right now as inflation has been coming down. I know, obviously, you still have the tariff argument out there. I don't believe the tariffs are going to be as bad as people think they're going to be. I think we've kind of, people I think have kind of seen that, and they over the last couple of months that the market's bounced back, everything's bounced back, everybody's kind of getting over that initial tariff shock, if you will. So again, M&A not dead, going okay at the moment. I think there is a lot of reason for optimism going forward, and we'll see what happens the second half of the year. I do believe things will pick up the second half of the year, especially if we could begin to see, and again, I don't think we need like a ton of tariff deals, but I think if a few tariff deals start to roll in, and it looks like there's momentum there, and we start to pick up a lot more, that starts to ease out. Even if the prolonged tariffs with China continue to drag on, I think that overall things will calm down, especially if especially if the Fed does begin to start reducing interest rates, even if it only at a quarter point clips at a time. That will really spur, I think, a lot of M&A transactions. A lot of people will finally come off the sidelines, and things will start to move and things will start to happen. So with that being said, that is the M&A update right now. Like I said, in another 3 to 6 months, as more information rolls in, I'll come back to you guys with another M&A update, let you know what's going on in mergers and acquisition world. But until then, I'm going to sign off by basically saying, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I hope everyone has a great day out there, and I will see you all again real soon. Thanks a lot.